Hi class, welcome to lecture 4.3, Stocks and Their Value Part 1. Now this is going to be based off of chapter 9 in your book, but before I get going too much further down this, I want to let you know that a good bit of your test, exam 4, will be based off of chapter 9. However, part 1 and part 2 lectures will not have a great deal of conceptual questions from them. There's probably going to be 30 questions on your test. You're going to have probably two-thirds of those be math problems. Maybe one-third from chapter 9, one-third from chapter 8. So there'll be another third that will be, maybe 10 conceptual questions from chapter 8 and chapter 9. And a good bit of those might come from these two lectures, but you'd also see them if you look over the test guide as well. So, with that being said, if you want to see some more additional practice problems out of Chapter 9, I've written those down here below as well. You can obviously do all the problems if you want even, more practice. But remember to focus on the test guides for Exam 4. Okay, with that being said, let's move on. I think one of the first things you want to make sure you understand is what kind of cash flows do shareholders or stockholders receive? Now, they're really only going to get one of two things, dividends or capital gains, right? And so as long as you understand that dividends are a, short-term cash income scenario and that capital gains are more of that long-term selling scenario, then I think it makes a little bit more sense. Sometimes it might help to think of it as, your dividends are the same thing as the coupon payments for bonds. It's just they're not guaranteed and they may not be consistent. The capital gains is what you get at the very end when you sell. Just kind of like with bonds, you'll get a principal back when that bond matures. Now, with bonds, it's always going to be steady. It's whatever price that bond's worth, usually $1,000. With capital gains, you have no idea. You may have made a lot of money. You may have not made any. You may have lost some money. And there's obviously the risk difference there between stocks and bonds. Nonetheless, the price for a stock is calculated pretty much the exact same way the price for a bond is. You're going to just calculate the present value of expected future cash flows. And so keep that in mind as we go through this lecture. Let's take a one-period example. Suppose you were thinking of purchasing the stock of Moore Oil Incorporated. You expect to pay a $2 dividend in 1 year. Okay. You believe you can sell that stock for $14 at that time. You require a return of 20% on the investments for the risk that you're going to bear. So what is the maximum price you'd be willing to pay for this stock? Well, if you've already seen the test guide, then you know we're going to use what's known here as the dividend growth model or the dividend discount model. And so since they're talking about next period for the dividend or the dividend 1 year from now, that's going to be called D1. If it was the dividend just paid, that would have been D0, right? So D1 is going to be $2. Your required rate is 20%. P1 is going to be the rate in a year from now. I mean, the price a year from now, and that's $14. So that's what you would sell it for, right? So your cash flow 1 year from now is going to be $2 dividend plus that 14 bucks. Kind of like with a bond where you'd get that interest from that last payment period and then also the principal back. Here you're going to get money from not only the dividend but from selling the bond. Selling the stock. So this brings us to a basic dividend discount model problem. You've got price P0 is going to equal that D1 times 1 plus G over R minus G. Sorry, that D1 over R minus G. But as you can see, that's not what they're doing here. What are they doing here? They're not using the dividend growth model. What are they doing? Does anybody know? They're using the time value of money problem. Okay, so if you remember that future value equals present value times 1 plus R raised to some n exponent, that's what they're doing here. You don't see any exponents because we're only dealing with 1 year, so that it would be just 1.2 raised to the 1. But now they've rearranged that equation because we're solving for present value instead of future value. But that's all this is. This is a basic time value money problem. Okay. And so they've just solved for present value. You could do this with with the time value money buttons on your calculator as well. You want to prove it, make n equal to 1, make your future value 16, make your payment 0, and then make your I equal to 20%, solve for present value, and that's what you would get. Now, some of you say, but there was a payment. There was a $2 payment. Fine. Make your payment $2, make your future value $14, and then solve for present value. Same thing. Okay? So, just because you might have already worked the test guide, I just want to let you know you can also do these using time value money problems. We will get to the dividend discount model in a second, but just bear with me a little bit. The dividend discount model is going to help you when things start to get even more and more complicated. For example, let's look at a 2-period example. What if you decide to hold this stock for 2 years? Okay, now you've got 2 dividends to deal with, so you got more cash flows, right? So cash flow 1 is going to be your dividend period 1. Cash flow 2 is going to be not only that dividend plus what you're going to sell it for. So how much would you be willing to pay for this? Now you could put these cash flows into your calculator, or you can use this equation here, but this is a cash flows problem like you did in exam 2. Okay? Still not really gotten to the dividend growth model just yet. What if you've got 3 periods? Okay, now this is still looks, just like a cash flow problem. Cash flow 1's $2, cash flow 2's $2.10, cash flow 3 is, and then you've got that dividend in the 3rd year plus the price in the 3rd year. Okay, so you could put all this in your cash flows buttons, or use the formula I have written here. And you could keep doing this on and on and on, right? 4 periods, 5 periods, 6 periods. But let's talk about what's really going on here. You could continue to push back when you would sell the stock. But what you're going to find out is that you're really just finding the present value of all expected future dividends. Does that make sense? In other words, the equation you're really looking at is something more like this, right? Where you're basically just summing up each one of these different time value money problems, and in other words, you're discounting all of these future cash flows back to the present value. Now, I keep promising you guys that I'm going to talk about the dividend growth model, right? Well, that's actually going to happen in a special case here, when we have a constant dividend growth. So I want to go over 3 different cases here. Constant dividend zero growth, which is going to look just like a perpetuity, which you've seen before. And the constant dividend growth, which is the one that is the model that you see for so many of your problems on the test guide. And then supernormal growth. Dividend growth is not consistent initially, but settles down to constant growth eventually. And you'll see a couple of supernormal growth problems on the test guide. I call them 2-stage problems. I don't like the word supernormal growth. I just don't think that that's the best label you could put here. But nonetheless, that's what we mean by when you hear the term supernormal growth. Craziness up front, and then things settle down. So let's take a look at zero growth first. Dividends here are going to look, are going to pay at, a regular interval forever, so that's nothing more than a perpetuity, right? Now, if you remember the cash flow, the equation for a perpetuity looked like PV equals C over R. Well, here, your PV is going to be your original price in year 0, so P subscript 0. Your cash flow is your dividend, so C becomes D, and then you still got the same R. Right? So this is a super easy problem. You've got one on your test guide, and you'll love to see it on the exam. This is about as easy as these problems can get. So let's take a look. Suppose the stock is expected to pay 50-cent dividend every quarter, and the required return is 10% with quarterly compounding. What's the price? Now, it's important they say every quarter, or that there is no growth, right? G has to be 0 here. Okay? And if that's the case, all you got to do is put 50 cents over R, right? That's all you got to do, right? Put 50 cents over R. Well, be careful. Look at what the required return is. It's 10% with quarterly compounding. So in this case, you're going to look at that 10% as the APR. To get the periodic rate, you're going to want to divide that by 4, okay? And somebody might ask, well, how did you know to do that? Well, remember, you've got to keep your periods the same here. So if you look back up there, it says there's a 50-cent dividend every quarter. So you need to use also a quarterly rate in the denominator, okay? And then you're going to get 20 bucks. If you wanted to, you could have multiplied 50 cents times 4 and gone with $2, and then you could have used the 10%, and then you've got, annual numbers and then numerator and the denominator, you still would have gotten 20 bucks. Okay, hopefully that makes sense. Now let's move on to the constant growth stock. Here you're going to look at dividends growing in kind of the same way that you'd see time value money problems, right? Think of D0 as present value, think of D1 as future value, and you'll see that that's first equation is nothing more than a regular time value money problem. And then you can see that you can basically solve for, any future dividend using that third equation. Wait, I see there's a mistake there. Let me fix this real quick. If you notice, you'll see where it says dt equals dt1 plus g raised to the t. Let's fix that real quick. Now, if you caught that, I just changed that dt equals dt1 plus g raised to the t to a d0 in there, right? So dt equals d0 1 plus g raised to the t. Okay? Now, save that so that make sure that that's in your PowerPoint slides. And then you've got d subscript 0 equals dividend just paid. And what does that mean? Well, all we're trying to let you understand there is there's a difference between d subscript 0 and d subscript 1. D1 would be the dividend paid next year. Okay, so just paid or current dividend is d subscript 0. Anything dealing with next period or 1 year from now is D1. Okay. Now let's go ahead and throw in the G and see what this looks like. If we use a constant growth rate of 6% and start with a D0 or the current dividend of $2, you can see how D1 is going to grow to $2.12, and then D2 is going to grow to $2.25-ish cents. Now, why didn't it grow to $2.24? Because it's not growing by 12 cents every year. It's growing by an interest rate that's going to be, or a growth rate that's going to have a compounding effect, right? We've talked about compounding interest. It's the same kind of idea here with this compounding growth rate. And here, let me go ahead and bring over this D3 so that you can see it as well. And as you can see, that's not going to be $2.36. You've had some compounding or growth, and so you've got $2.38, right? Let me save that. Okay, now let's move on to the next slide. And voila, what do we have here? This is the dividend growth model, or what I might sometimes refer to as the dividend discount model. For this class, don't worry about it. I use those terms interchangeably. It's also sometimes referred to as the Gordon growth model. Okay, and what you're going to notice here is that we have this P subscript 0 equals D subscript 0, 1 plus G, all in parentheses there, over R minus G, equals D subscript 1, and then you have an R minus G again. So the numerators there and those two second parts of that equation are the same thing, right? D1 equals D0 times 1 plus G. And we know that. We've already talked about that. So the reason it's written this way, though, is because a problem might give you current dividend, might give you the dividend next year. So either way, you've got a formula that's ready to rock and roll. Let's take a look at an example. Suppose Big D Incorporated just paid a dividend of 50 cents. It is expected to increase its dividend by 2% per year. If the market requires a return of 15% on assets of this risk, so there's your R, how much should the stock be selling for? Okay, so we're trying to solve for price. You know the equation. You plug in 50 cents for a current dividend because it was just paid. You throw in the growth rate in the numerator and the denominator. You throw in R, you just plug and chug, and you're going to get $3.92 as the price. Make sense? So now you know what the price of this stock is based on its future cash flows. And you can do this with a whole lot of different examples. In fact, this lecture has nothing but a whole lot of examples in it. Suppose TB Pirates Incorporated is expected to pay a $2 dividend in 1 year. Okay, so there is your D1. If the dividend is expected to grow at 5%, G, per year, and the required return is 20% R, what is the price? Plug those in and you've got $13.33 as the price. So it's important to see a couple things going on here. One is that the stock price is going to be sensitive to dividend growth, and that makes sense. A stock that's got a high growth rate for its dividends is going to be worth more, so you'd pay more for it. And then that stock is actually going to have the opposite effect with R, right? The higher return that's required, the lower that stock is worth to you, right? So if you require a 25% return on a certain stock, then that stock may not be worth as much money to you as it might be to somebody else that doesn't require as high of a return. Let's look at some quick examples. Gordon Growth Company is expected to pay a dividend of $4, so there's D1, next period. How did I know that word next? And dividends are expected to grow at 6%. There's your G. The required return is 16%. What's the current price? You plug and chug, $4 over 10%, you're going to get $40. And we've seen a problem like this before, but let's mix this up. What if I was actually trying to figure out what the price was in 4 years? So what would I expect this price to be in year 4? Well, remember, you can adjust these equations to solve for price in any year, right? So P4 would equal D4 1 plus G over R minus G, or D5 over R minus G, okay? So if you can go ahead and plug in what that dividend is, then you can solve for this problem. Now, what is that dividend? Well, you can use D1 times 1 plus G to the 4th to get D5. Or you could, if you had D0, that could have been D0 times 1 plus G raised to the 5th. Okay, but we had D1, so that's why you went with that. You figure out what that is, or you could just plug that equation like it is straight into the numerator, and you solve, and you're going to get $50.50. Make sense? Well, good. Well, now let's talk about some conditions for this formula as well. A couple of conditions, or maybe you could say assumptions, for this model. It's one that dividends are expected to grow at G forever. Okay, so when we say constant, that's what we mean, constant growth. The stock price is expected to grow at G forever. Okay, and that tells you that your capital gains yield is pretty much equaling your dividend growth rate. The expected dividend yield is constant. Okay, and why would that be constant? Well, your dividend yield is nothing more than your price in the denominator and D1 in the numerator. So it's D1 divided by the original price. So it makes sense then that dividend yield would be constant, because both that dividend and that stock price should be growing at the same G. Number 4, I already mentioned that capital gains and the dividend growth rate are going to be both equal to G. Number 5, expected total return for R must be greater than G. Okay, that makes sense. You don't want to have a negative number in your denominator, right? So, because you would never get a negative price. And one of the unique things from this is that you can look at the total return, or R, as a combination of both the dividend yield and the growth rate, right? So, and that makes sense too, because how do you get paid for a stock? You get paid for a stock based on both dividends and capital gains. So the dividend yield tells you the dividend part, and the capital gains yield is the other part, which is represented, here in number 6 by G. Now let's take a look at non-constant growth. Suppose a firm's going to increase dividends by 20% in 1 year, 15% in 2 years, and then after that they're going to increase at a rate of 5% per year indefinitely. Okay? If the last dividend was $1 and the required return is 20%, what is the price of this stock? Okay. Now it's important to note that we have to find the present value of all future cash flows, right? All future dividends. So this is going to look something like some of those 2-stage problems on your test guide. Let's look at what cash flows we know. Okay, we know that D1 is $1.20. We know D2 is $1.38 because we multiplied that first one by 20%, the second one by 15%, right? So that's how we get the $1.20 and the $1.38. And then D3 is going to be at 5%, but that's going to be a constant growth rate from there on forward, right? So let's start with what's in the furthest in the future first, because we're discounting everything back. And what we want to do is figure out what is P2. Okay, now you could have probably figured out P3 as well, so it's up to you which one you want to solve for, but here we're going to do P2. We know what D3 is. Okay, so let's throw in the equation, the dividend discount model, or the growth model equation, and you're going to do $1.40 almost $1.45, right? $1.44.9, and then you're going to put that over 20% minus 5%, right? Because we're using that constant growth dividend, or that constant growth percentage for all future dividends, right? At 5%. You're going to get that P2 is going to be $9.66. Now, somebody said you could have solved for price 3. Yeah, but if you do solve for price 3, when you get your cash flow 3, you're going to have to add in D3 as well. Okay, so just kind of keep all that in mind. If you go with P2, you're only dealing with 2 cash flows, right? Cash flow 1 and cash flow 2. So to find the present value of those expected future cash flows, you could do it like it's here, or you could throw those into the cash flow buttons on your calculator. Okay. Either way, you should get $8.67. So that was like a non-constant plus a constant growth problem. Here are those 2 equations if you want to take a look. Remember though, what you're really just doing is that dividend growth model first, because it's the furthest in the future, and then it's a cash flow problem. So here's what those formulas would look like if you inserted the actual time periods. And here's what that problem would look like if you went ahead and drew it out on a timeline. In other words, this is just a whole lot of ways to show you how to get $8.67 for the price of this stock. So let's take a quick quiz. What's the value of a stock that is expected to pay a constant dividend of $2 per year if the required return is 15%? So if it's paying constant, there's no growth rate. This is easy perpetuity equation. $2 over 15 cents, $13.33 is your price. Okay. What if that company starts increasing dividends by 3% per year, beginning with the next dividend? Okay. Now we're just using the dividend growth model. Put in $2, 1 plus G over R minus G. G is 3%. R is 15%. You're going to get $17.17. And that makes sense too, that the price in the second example is worth more because there the dividend is growing, right? So that's obviously a more valuable stock than the one that's going to pay you a constant non-growing dividend. Now something else you'll see on the test guide, and we've kind of already mentioned here, is that you can rearrange this dividend growth model to solve for R as well. And when you do that, what you're going to set up here is eventually, if you look at the bottom, R equals D1 over P0 plus G. And that D1 over P0 is also known as your dividend yield. G is also known as capital gains yield. Once again, that makes a lot of sense, right? Because that's the 2 ways that you can make money off of a stock, is through dividends and through capital gains. So let's take a look at an example. Let's tell you the price is $10.50, D1 is $1, and G is 5%. So what is R? Well, you could have plugged those straight into the dividend growth model and just solve for R, or you could have it rearranged for R like we've talked about and then plug it in. Either way, you're going to get R equal to 15%. So here this slide is just showing you that you could have figured out the dividend yield as 10% and the capital gains yield as 5% and added those 2 together and also gotten 15%. Okay, and that hopefully makes a lot more sense to you as to how you can manipulate the dividend growth model to solve for R. And here's a pretty nice little summary of these equations. I also gave you an equation page that I went over a little bit before the review for test guide part 2. Now let's talk about a couple quick features of some common stock. So as far as voting rights go, there's 3 different things we're going to talk about here. Stockholders are who elect the board of directors, right? You get cumulative voting versus straight voting. I talk about this a little bit in your test guide because you have got one problem working a cumulative voting versus straight voting problem on your test guide. I'll use a couple examples to explain to you some cumulative versus straight voting problems too. I think if you look at numbers 3 and 4 on the test guide, or maybe it's 4 and 5. I think it's 4 and 5 on the test guide. One says Mary owns 100 shares of stock. Each share entitles her to 1 vote per open seat on the board of directors. Assume there are 3 open seats in the current election and Mary cast all 300 of her votes for a single candidate. So that is describing cumulative voting right there. And then if there were 2 open seats on the board of directors, and if 2 separate votes occur to elect the new directors, the firm is using a type of voting that would be best described as straight voting. Okay, so to boil it down, with straight voting, you need to have 50% plus 1 additional share of all the shares out there to voting in your favor to get that board. Whereas with cumulative voting, it's kind of like musical chairs. You just need to have enough votes to get that last chair that's available. So if there are 5 chairs available, or 5 different seats, so to speak, on the board of directors, then what you need to do is make sure that you are at least the fifth. You've got at least the 5th largest number of votes, and that's called cumulative voting. And in that case, you could make sure that happens by making sure you own, or you've got a group of 1/6 of all of the shares plus 1 additional share, because that makes sure that there's not anybody out there that's got, or at least there's not 5 people out there that have more votes than you. And then with proxy voting, so every shareholder gets to have a vote. Now, if you don't, a lot of times your vote might not mean much because you don't own very much of a company. Like I could say I own Ford, right? Well, I'm not the only owner of Ford stock out there. In fact, I own very, very small percentage. So I could vote by proxy if I wanted to. Proxy is a document giving one person the authority to act for another. Typically, it's more like the power to vote shares of common stock. So that's what you'd see. Sometimes you can see things like a proxy fight, especially during like a takeover attempt. A proxy fight's an attempt by a person or a group to gain control of a firm by getting its shareholders to grant that person or group the authority to vote its shares to replace the current management. So it's kind of a way of maybe taking over a company. There are also a variety of different classes of stock. So companies can decide to issue different types of classes of common stock to certain investors or board members or even company founders, which would be founder shares. With Class A and Class B, usually you're talking about maybe different voting abilities or voting rights. So, for example, one Class A share may be accompanied by 5 voting rights, while one Class B share may be only accompanied by the right, 1 right to vote. So these classes of stock sometimes, have many different characteristics, but one of the most obvious ones is voting rights. Now, why even do this? Well, the main reason for this is usually to give key company insiders greater control over the company's voting rights. Maybe you've set up the company and you want to make sure that the company stays in the direction that you set it up for. So you might issue, you and a couple of other maybe founders of this company, certain types of shares of stock that allow you to maintain control of the company, without necessarily having to own more than half of the outstanding shares. And no matter however they set up these differences, I think it's also important to remember that usually founder shares or Class A or Class B shares, they're all going to typically have the same rights to profits and company ownership. In other words, investors of any type of these shares are going to see a fair share or equal share of the company's return on equity. So here I've listed some rights that they're all going to share, all different types of common stock together. They're going to share proportionally in declared dividends, share proportionally in remaining assets during liquidation, and this preemptive right is really just a right of first refusal to buy new stock issue to maintain a proportional ownership if desired, which basically means if I own 10% of a company and they're going to issue new stock, they got to let me know so that I can maintain my 10% in the company if I want to. Now, once again, a few key characteristics of dividends: they're not guaranteed, and so they're not really a liability for a firm until the board of directors says we're going to pay them. So if you're going to go bankrupt, if you declare the dividends, then you're obviously not going to declare the dividends, right? As far as tax purposes, dividends aren't going to be taxable for a firm, but they will be taxable for the individuals receiving them, and they're usually taxed as ordinary income, although some dividends are treated differently. And that usually is a difference between qualified and unqualified dividends, but you don't need to really know that for this exam. Dividends received by corporations have a minimum 70% exclusion from taxable income. Now, what does that really mean again? That really just says, say for example, if a company owns less than 20% of another company, then it's able to deduct 70% of the dividends it receives. The main thing I want you to understand is really that firms can not only issue dividends, they can collect them as well. Now this brings us to preferred stock. Now think about dividends. Dividends must be paid to preferred shareholders before common stockholders. So this is preferred stock is above a Class A share or founder share or any other kind of shares that have different voting rights. In fact, preferred stock generally doesn't have any kind of voting rights. It's really about having priority as far as collecting dividends. So dividends have to go to preferred shareholders before they go to the common stockholders. It's not a liability of the firm, and it can be deferred indefinitely. Most preferred dividends are cumulative. And what this is really means is a preferred stock might have like an annual fixed rate dividend, and if it can't be paid in any year, then it's going to accrue until it can, and until it can be paid, and it's going to be paid before common dividends are paid. Now, what about stock markets where there's a primary and a secondary market? Primary is where you get new issues. Secondary market is where like the New York Stock Exchange, NASDAQ, places where we would go maybe to buy stock. So I know that seems like a big deal, and maybe that would be primary, but there's a lot that happens actually before stocks find themselves on that exchange. Okay, dealers versus brokers. Dealers have to maintain an inventory, ready to buy or sell at any time, kind of like a used car dealer in a lot of extents, where a broker brings two people together. So think about it like a real estate broker. That'd be a great example. Now, the New York Stock Exchange is by far the biggest in the world. NASDAQ is the next. And then you've got, a lot of countries have their own stock exchanges. The London Stock Exchange is pretty big. Toronto has a pretty big stock exchange. China has several stock exchanges that are growing. So historically, to be a member on an exchange, you have to buy a trading license or own a seat. And other members would include like commission brokers, specialists, floor brokers, floor traders. And I give you some examples in your test guide to kind of explain what these folks do. But for the sake of time, as long as you understand the test guide, I'll leave you alone there. If you are interested in what a specialist does, just kind of think about the fact that each stock has one assigned specialist, and that all trading for that stock is going to occur at that particular specialist post. And then trading is going to take place between the customers, orders placed with the specialist, and what's referred to as the crowd. And the crowd is going to be just a combination of commission and floor brokers and traders. So I just wanted you to have an idea of some of these terms going into maybe job market or interviews. If somebody mentions one, maybe you have heard some of these terms. I'm not really concerned with you becoming really proficient in understanding the differences. I think after a period of time you would see the differences, and also a lot of people get these terms mixed up anyway. So and some of them are fading and going away as they're being replaced by internet and decimalization and a bunch of different economies of scale that have developed since we've increased our technological capacity. Now here is slide about NASDAQ. NASDAQ is the National Association of Security Dealers Automated Quotation System. You don't have to know that either, but it's basically all been on computer pretty much. It's just a computer-based quotation system. It has a lot of multiple market makers. And market makers are just dealers in securities or other assets who undertake to buy or sell specific or at a specified price at all times. So they're kind of the grease that makes sure the market runs the way it should run. And a high percentage of all the tech stocks are out here on NASDAQ as well. And then I just added this 3 different levels of information just to give you some more information. Level 1 is where you get the median quotes, registered representatives. Level 2, view quotes, brokers and dealers. Level 3, view and update quotes, and that's just really for dealers only. And this brings us to electronic communication networks, or an ECN. They're just an automated system that's going to match buy and sell orders for securities. That's all I want you to know. Here I've provided you with a stock quote just so that you can kind of see what information might be available. You can find all this on Bloomberg or Morningstar or Yahoo Finance or whatnot. Here you'll see Harley Davidson, and their ticker is HOG, which would make sense. And but you can see that they're going to list the price and the volume and how that's changed over time. They're going to give you the ask price and the bid price and the 52-week high and the 52-week low. What's its return over the last year and what it opened at for that day. So there's a lot of information there, and you can use that for that information for deciding if this is a good time for you to get into it or a good time to get out of that particular stock. And you can obviously go online and get a lot of information. Some online trading sites are going to show you their order book, limit order book, all right there online. So if that's something you're interested in, like I said, there's just a million websites that you can look at to get some of that information. That being said, let's end with a real quick quiz. Really getting back to this dividend growth model, because that's really kind of the bulk of what I want you to get out of this lecture and for Chapter 9. You observe a stock price of $18.75. You expect a dividend growth rate of 5%. So there's your G. And the most recent dividend was $1.50, so that's your D0, right? What is your required return? Remember, you could rearrange that for dividend yield plus capital gains yield. To get the D1, you take D0 multiplied by 1 plus G. And to get the price, they told you that, so there's your dividend yield, and that's going to be around 8.4%. And if you add that 5% growth rate, there's where you get the 13.4% for your required return. Okay? So hopefully that was just a reminder slide there of some of the main math that we talked about. There's some decent conceptual material there. You might want to try to match it up with some of the conceptual problems asked on the test guide, and I think it'd be pretty obvious what types of questions you might see on the exam. Okay? Thank you very much. This was lecture